Hey, what is up, guys? Tyson Dela Cruz here from the Real Estate Experts Podcast. Today, we have an awesome show for you. Today, we have Senior Loan Officer Josh Jensen from Simplify Home Loans. We're going to be dropping in and talking about the existing mortgage rates, what type of programs are available for house flippers and wholesalers and hotelers, what type of opportunities are available for your consumer as a real estate agent. Thank you guys so much for joining me. Let's roll into the intro.
Welcome to Real Estate Experts. Join us to democratize the secrets to real estate for everyone, everywhere. Thank you for being here. Let's see what our experts have to say today.
Josh Jensen, Senior
Mr. Dela
Loan
Cruz.
Officer. What's going on, man? How are you, brother? Did we lose him? Did we lose him?
There we are. That's a heck of a start right there.
That's a start.
Let's just go right to a blackout screen.
Blackout, baby.
What's going on, sir?
What's up, Josh? How are you, man? You are looking studly than ever, man.
I try. Had to get rid of the beard for the daughter. I'm trying to catch back up with you, sir.
Thanks, man. Thanks. For those of you that don't know you, may you share a little bit about your background and how you got started with loans?
One more time, sorry.
Yeah, if you're open to sharing a little bit about your background and then how you got started as a loan officer.
Oh yeah, absolutely. So I actually originated my first loan back in 2001, just right fresh out of high school. The owner of our company now was actually a really good friend of mine growing up and was working at a telemarketing center. The manager of the telemarketing center was dating a loan officer at the time when you didn't need to worry about getting any sort of licensing. It was, hey, can you do the job? Perfect. So she was talking to him, says, hey, I have an 18-year-old that I think would be a really good fit. He ended up getting a job doing as a loan officer, focused on VA streamline refinances, brought me on, and I've been doing loans on and off since 2001.
Awesome, man. Because I remember when you first started, you were predominantly only doing VA loans. Now you do in a plethora of different types of loans, correct?
Yeah, so almost for my entire career, it's been focused on VA IRRRLs. For those of you who may not know what IRRRL stands for, it's an interest rate reduction refinance loan. For veterans with their primary home, or if they have a VA loan existing, they can do what they call a streamline refinance, where you drop rate, drop payment. There's no appraisal, none of that. It's a very, very easy loan to perform. However, VA loans are, outside of USDA, one of the smallest markets. So Simplify Home Loans started back in 2017, so about 5-6 years ago, on the thought process of doing more than just VA. And that's where we ventured out to doing cash out refinances, both FHA, VA, conventional, USDA, purchases, bank statement loans, DSCRs, basically everything that's out there we can do.
So now you're offering a lot of different array of types of mortgage loans. Tell me a little bit about what you see in regards of the economics moving into 18 to 24 months from now, and how that might affect business in general.
So realistically, me and the loan officers that are here are hopeful that the rate increases that we've seen for the month of September, because it has been a lot. Interest rates have jumped up close to 2 full % on government loans and almost that on conventional loans. We're hoping we're hitting the point, and then it's going to drop back down, maybe mid fours, definitely lower than where it is right now. And we've been telling our borrowers we hope to see that happen within the next 8-9 months. So rates should be going down, just due to the fact that the mortgage industry is not going to be able to continue with house prices at interest rates at 7, 8, 9%.
I 100% agree, man. I think, as I think it's like easing of raising interest rates to reduce borrows, which kind of stinks because then there's not a lot of options for traditional buyers. But
No.
I feel like on the back end, wherever the institution kind of originates their funds from, they still have to move that money, right? So
Yeah.
I think there's an option for creative companies, house flippers, maybe individuals that are looking to refinance or acquire more rental properties. There's a lot of new programs out available. Are you open to speaking about some of those new programs that are out and available for house flippers and people that are looking for rentals?
Yeah, absolutely. And I more focus on the investor who's looking to hold onto the loan versus flip it. Flip loans aren't really something we've really dived into. However, we do a lot of non-QM or non-qualified mortgages for bank statements, or right now a really big one is DSCR loans. DSCR loans give you the opportunity to not have to worry about it qualifying with income. You don't really even need much other than a good credit score and proof through your appraisal that your principal, interest, taxes, and insurance is going to cover or is going to be covered by the rent. I've done a couple DSCR loans just in the last couple months, and I got one more that I'm working on where they just reach out, say, hey, here's what the estimated rental is going to be. Here's what the PITI is. I have my 25% down, which is the kicker, is on those you do need 20 to 25% down to get that versus traditional where you can get 15%. But again, the more you put down, the higher the interest rates are going to be.
And let's dive into that a little bit regarding percentage down and potentially buying down some of the interest rates. Um, is that an option on some of this on some of these loans?
It is. DSCR, I believe, can go to 20% down. Conventional investment properties, we can get 15. However, the sweet spot for investment properties or non-second homes is 25%. One of the reasons that is more lenders offer 25% versus your niche lenders who are trying to corner the market with a little bit less down, but your interest rate's almost 1.5 to 2% different for every 5% you go up.
Now, are you talking unseasoned or seasoned funds? And for those of you that don't know, seasoned funds obviously in the account, they've been there, they've been marinating for a while. Unseasoned is, I think less than 30 days, right? Would you qualify that as unseasoned?
I'd qualify that as unseasoned, yes, sir.
Cool.
Most of the time it is seasoned.
Got it.
Or we have at least a very, very good, I guess, transaction history of it coming from point A to point B to point C. As long as we can justify that it makes sense, we generally can get it done.
Awesome. What other type of programs have you been kind of seeing coming down the pipeline in regards of the leniency of potential lending?
Realistically, government loans are fantastic with leniency. Perfect example is I have a loan closing tomorrow that he has I want to say like a 545 FICO and 51% debt to income. But because he meets VA's guidelines in regards to residual income, we're able to get the loan done. FHA, very similar. You just can't be below, above 50% debt to income. And then of course, conventional is always going to be the least lenient. In fact, I'm taking borrowers away from conventional loans, putting them in FHA loans, just because the interest rate is lower, and even with the mortgage insurance, they're getting a lower monthly payment. Which, in the grand scheme of things, that's what my job is to put you into a position to spend as little as possible every single month. I don't care if the interest rate's 4 or 6. If that dollar going out every month is lower, that's the program that I'm going to recommend.
Actually, you're one of the first loan officers that I've actually heard that come out of their mouth. A lot of loan officers are so um, confined about like what's going into their pocket, so they'll put the borrower in a position where they know that they can't necessarily borrow, and they'll just do it at the risk in order to get their higher commission. So like I 100% applaud you for like really navigating the borrower through a situation like that, man.
Well, and one of the reasons is, and just full disclosure, is most of the loans that I'm closing right now with where the interest rates have jumped up significantly are people I've done refinances for in the past. Luckily, over 5 years, 5.5 years, we've built up a big enough book to where we could almost um, maintain our portfolio by refinancing borrowers. Great example is on Friday, borrower called, or not Friday, the loan closed on Friday, but borrower called me up, says, Josh, me and Jimmy's getting divorced. I got the house. I need to refinance. So we ended up taking her ex-husband off the loan, and put her an interest rate at 5.5%, where she was at a 2.25. And she knows full well in 6 months, if the rates have dropped, or if the rates have dropped a little bit, we're going to do another refinance and drop her payment down and continue to do that until she's happy with her rate.
I love that, because wouldn't you agree that most borrowers, look at home acquisitions in a few different buckets? One of them, obviously, being the interest rate. The other one is monthly payments, and then the third, I feel, is the total cost of the asset. Um, I think more so people focus on the monthly payment amount. How do you fare about
Yeah,
that?
yeah, absolutely. And as they should. Um, you can come in with pretty interest rates, you can come in with low cost. In the end of the day, none of those really matter. If your interest rate, or if your monthly payment, regardless of what program, is $1,500, whether you're at a 4.5% on an FHA with mortgage insurance or a 7% on a conventional, end of the day, the only thing that your bank account truly cares about is how much is coming out of it. There's your mortgage statement doesn't, it shows a picture of how it gets to those numbers. Your bank account doesn't care. End of the day, having a conventional loan doesn't make you any better than somebody with an FHA home loan. It just means you may or may not be spreading out your payment in a different way.
Agreed. How do you feel about some of these new loan options for minorities in lower demographic areas? One of the big ones that kind of come to mind is this newest thing with the B of A. No credit check, no monthly requirements. How do you feel about loans like that? Because those are high risk
It's
loans, right?
yeah, it's scary. Um, One of the things, and I believe it's due to the fact that B of A may have been not necessarily as diligent with their HMDA practices, where you have to get race, where you have to ask ethnicity. And if your portfolio is skewed to one demographic, CFPB is going to come in and they're going to look at it and be like, hey, what's going on here? Um, that may be the case with reaching out to minorities and coming up with these programs, but they still need to do their due diligence and they still need to qualify.
I agree, because I think some of those loans are a little high risk long term for economics. I'd love to
Mm-hmm.
hear your chime on it, but long term in regards of economics, an individual who can't necessarily afford a home, is now qualified for a home because they have utilities and they're in a specific area. But like long term, is that sustainable for that individual to like actually qualify that home? I personally think no. I think this is something that could potentially hurt the borrower in the future.
Yeah, absolutely. It goes back to 2005 to 2008. I'm sure almost everybody listening has seen The Big Short or knows what The Big Short is, the movie, where the option arm program just completely destroyed the housing market. I deal with it every single day when everybody comes back and says, oh, we're going to have a housing crisis like we did in 2008. We're not. The 2008 housing crisis was due to the fact that people who should not have been given loans were given loans. They were given a loan that gave them the opportunity to not have to pay anything on it by having a negative amortization loan. And then when the time came for it to be fully amortized, which between 2003, 2005 was going to be that 2008 timeframe, they couldn't afford their payment. Anybody's going to get comfortable with a lifestyle. If you're living in a $600,000 home at a $900 a month mortgage payment, and then come to find out 5 years later, you now have a 25-year loan at a 7% rate, fully amortized at $675,000. In some cases, that's a $2,000 to $3,000 swing in mortgage payment, where you've already built up a lifestyle to where that's not going to work. That's what caused the housing crisis in 2008. And if B&A continued to do bank statement loans or not bank statement loans, but stated income or whatever parameters they're using that may not really qualify the borrower, you're going to have in those depressed areas, you're going to have very similar circumstances where homes are being foreclosed on, people are being kicked out. And now somebody who may have been renting, having an opportunity to build up their credit to purchase a home, going through conventional means or going through qualified mortgages, now has a foreclosure on their property, and they just put themselves in the hole for the next 7 years without anything to show for it.
Agreed. Yeah, I do feel that, in regards of housing, the cost of housing, I personally feel that I think we'll see anywhere from, a 15 to 30% decrease in regards of the cost of housing. A little bit of pre-pandemic levels in the next like 18 to 24 months.
Right.
I think specifically in the next 6 months, things will start to come down the pipe, and then we'll get a better idea of what we're actually looking at, coming into Q2 and Q3 of next year. I personally don't think that the administration is going to allow anything to kind of happen until then, but that's my personal thoughts. What are your views on it?
Oh, they're not going to do anything until after midterms. Yeah, they're not going to do anything after midterms except for give away more money, or try to stop more money from being given away.
Yeah.
And then once midterms hits, new change of guard comes in. Maybe the House is flipped, maybe the Senate's flipped. Who knows? But policies are going to be put into place to slow down the inflation. But in regards to the 15 to 30% of cost, where? That's my question, because I look at it, and I may or may not be in the demographic for investment properties. I look at it more along the lines of cash out refinances and purchases. I can't picture Utah, where I'm at in northern Utah, I can't picture that dropping 15, 20, 30%. But again, it's a booming tech industry. We have Silicon Slopes here, we have that. I don't know what it's like in Henderson or Vegas, or I don't know what it's like in Alabama in regards to values. I do know that over the last 3 months, I've seen a decrease of about 5% from what I'm estimating the homes to be on the appraisals that I'm getting.
So you're seeing an
and
actual
whether that continues,
5%?
I don't know.
You're seeing
So
a 5%.
I had one right now. So I have one that came in today. Did an AVM, which is an automated value method, basically an online appraisal that one of our partners that we use as a lender gives us access to. I believe it's called Canary. That's very, very accurate. They had the value between 230 and 275 with a confidence value of 250, and it came in at 225. So that's a little less than 6-7%.
Right. Yeah. It's not bad. It's not bad.
Yeah, it's starting to slow down, but realistically, it's starting to get where it should be.
For sure.
My neighbor sold his home. My neighbor sold his home for well more than what it's worth. because we live in a decent neighborhood, but there's no way in heck that there should be more than six figures on the value of my house, and it's ridiculous.
Yeah, I agree.
Yeah.
I agree. I think, some of the homes specifically, in the markets that I purchase in Arizona, Vegas, and Arkansas. Arkansas, not so much, but Arizona and Vegas, I feel that the prices, I think people say, oh, well, the prices are too expensive. No, the prices are like what they are. They're not too expensive. It's just what they are. And the market bared
Right.
that for so long, because the limited supply increased the demand. Obviously, somebody can ask for whatever they want for it. But do I find that they are inflated? For a 3-bedroom, 2-bath, 1,100, 1,200 square foot house for, 400,000. Do I think that that's a little like omni ridiculous? Yeah, I think so. I think in these high metropolitan areas, high density areas, I think, some of these values are a little inflated. Do I think like some stabilization is needed? Yeah. So I don't think, me personally, I don't think anything's going to be like you mentioned earlier, like '08, where prices, you're not going to pick up a
No,
home for $80,000.
no. But you're also not going to have 80% of the people who got an option arm foreclose on their house.
Right.
Because when, and I have to use this example, especially now with where the market's going and everybody's saying, oh, we're going to have a housing crisis, the bubble's going to burst, this, that, and the other. I'm like, and I'll specifically say, like in 2008, they're like, yeah, exactly like 2008. And then I have to put on my loan officer teacher hat and I have to do some education. I'm like, do you know why? Well, yeah, because the housing market crashed. No, that was what happened as the housing market crashed. Do you know why the housing market crashed? A lot of foreclosures. Okay, do you know why the foreclosures happened? No. And then you have to go into detail. People were given options and loans that they didn't qualify for. Again, they had extremely deflated monthly mortgage for 3 years. And when the time came to pay the piper, they couldn't afford it.
Yeah.
There's a reason that in 2013, we had all of these programs put in place to ensure that didn't happen. Now, talking about state, you don't have Joe Schmo at Gotcha Mortgage saying on documentation, or told me $15,000 a year, $15,000 a month as a line cook at Chili's. It's like this. Okay, it sounds good.
I agree.
Now
So
we have
anybody that's looking,
validations.
yeah, anybody that's looking to purchase a home, or, anybody that's looking to purchase a home, what would your recommendations be for anybody that has been looking to acquire a home for themselves? Should they do it? Shouldn't they do it?
Realistically, yeah, absolutely. Find somebody you trust. Find somebody you trust, whether that is a real estate agent, whether that is a mortgage broker. And you don't have to know them. You don't. You know right out of the gate, if the person on the phone, generally speaking, within 5-10 minutes, you'll have a very good idea on if or if not you can trust this person. I would say look at mortgage brokers instead of lenders. I'm doing that for two reasons. One, I'm biased because I'm a broker, not a lender. Number two, lenders, I have a buddy, because the company I worked for before, they were cap lending, and they're one of the bigger lenders. They make their end game is to make so their ultimate goal is $4,500 per thousand.
We lost them. Cut this from here, and then we'll hop back on. Hello?
Hey, yeah, I don't know what happened.
Hey, all good. You want to use that link, and then we can wrap it up?
Yep, I'm pulling it up right now.
All right, thanks, man. Yeah, I think the internet connection.
Yeah, it just says, wow, perfect. Okay, there we go.
Perfect. All right. All right, we'll cut it from there and then we'll drop it in from there. But I'll ask you that question again and then we'll wrap up. Is that cool? Perfect. Let me unmute you. There you go. Cool. You ready?
Yes, sir.
Perfect. So would you recommend anybody to purchase a home now, or would you recommend them to wait based on interest rates? Like, what's your personal thoughts on this?
So my personal thoughts is, yes, interest rates are a little higher than they were a couple months ago. They're 1.5 to 2% higher than they were in July, and they're 3% higher than they were in May. But when you purchase a house, it's your house. Whether you're spending $2,000 a month on your mortgage or $2,000 a month on your rent, you're still spending $2,000 a month. At least with the mortgage, you're getting something out of it in regards to equity, in regards to ownership. Also, when the home values start rising, you get to see the fruits of that, not your landlord. So absolutely. In fact, if it's your first home, get a starter home. Get one that's maybe not as big as you're wanting to start out with. That's fine. If interest rates dictate maybe a smaller home or a smaller purchase price, do it, but it's yours. And then when you go to sell the home, you've now put 50, 60, $70,000 in your pocket in regards to equity, depending on when you sell it, and you can use that to get your next home. It's called a starter home for a reason, and it's because that's where you begin, not end. So if somebody's looking to purchase a house, absolutely do it. You can at least get something for your money of that 2,000, 2,200, 1,500, whatever your budget is. You're at least benefiting versus just having a house over your head.
Absolutely, man. And I'm really a big proponent of anybody who is looking to purchase real estate, to buy real estate and wait, not wait to buy real estate. In the long term of things, real estate trends always go up, regardless if they dip a little bit. Agreed?
Agree. You can't build more land.
I love it. If any of the agents, house flippers, or clients of agents are interested in getting in contact with you regarding different types of lending options, where can they find you, and how can they get a hold of you?
So you can reach our website, Simplify, SIMPLIFY, homeloans.com. That has access to all of our programs. There's some really, really unique programs that we didn't get a chance to touch on for investors and for homeowners who have a significant amount of residual income every month. There's programs on there for that. Or you can just simply give my office number a call. I have no problem giving it out online. It's 801-734-9232. That will ring directly to my office. Just say you heard me on your podcast, and we can go over exactly what programs are in place and what things are available.
Thank you, Josh. Yeah, Josh has an abundance of different types of programs that are available for any flipper or client or whatever, and he can dive deeper into those programs. I'll also place a link to the website and Josh's information down below in the comment section. Josh, thank you so much for dropping in and sharing your knowledge regarding home loans and the process of home loans and where you think you see the market going. Josh, man, I really appreciate you hopping on the Real Estate Experts podcast, man.
Not a problem. Thanks for having me, Tyson.
Thank you. Let's roll the outro.
Thank you so much for tuning in. I have tremendous gratitude for our guests and you listening now for joining our mission of democratizing real estate education around the world. If you want to learn more from our experts, our mission, and get involved, then please visit realestateexperts.org to get started. Who knows, you might even be a guest on a future episode.